All right, it's day 178. I want to talk about why open earnings are not going to mirror Zillow and why Zillow got hit recently. Open reports next week, and I can see there's already a lot of fear out there in the Twitterverse. Zillow just reported a few days ago, and people are thinking housing is so weak, so Opendoor is going to be bad as well. And that's the wrong frame. First, a quick point on why Zillow disappointed investors, even with a quote good quarter. The reason number one is that expectations were too high for Zillow coming into the print. They've been executing well up till now. The stock was priced for it, so a strong quarter that was in line doesn't feel like a win in this environment. It feels like a no new surprise. Reason number two is the narrative didn't change about Zillow. They basically said housing is still bouncing along the bottom, legal costs are a drag, and the big upside is still when housing normalizes. And investors wanted a near-term acceleration story, not a steady progress story, which is what they got. And so now here's the key for Open. That reaction has very little to do with Opendoor that Zillow got this week, because they are different animals. So let me explain. Zillow makes money on activity, and Opendoor makes money on price and spreads. And that's very important. Zillow is a software platform and a toll booth on housing activity. If people search, they tour, they message agents, they apply for mortgages, Zillow gets paid. Opendoor is the market maker in the space. They take inventory, they set prices, they carry risk. That's what got them into trouble in 2022. So the question going into open earnings isn't did housing recover? It's did Open get better at the game that matters, which is dealing with a choppy market. So here are three things that I'm going to be watching for in the open earnings next week. Number one is inventory risk control. Are they keeping inventory duration tight? If the days creep up, risks creep up. Number two is contribution margin per home, not revenue, not volume, actual margin per transaction. And number three, evidence of the new playbook that Kaz is following. Are they prioritizing the quality of earnings over growth? Is there a tighter buy box, better pricing, better resale discipline? If those three things are going to improve, Open can print a quarter that looks very different from Zillow's, even if housing still feels like meh. So here's the rule that I'm using. Don't handicap Opendoor like it's Zillow. Zillow monetizes the funnel, and Opendoor monetizes the spread. That's something Kaz has been talking about a lot if you've paid attention. And spreads are a function of discipline. That's what next week is really about. And one more thing, in about half an hour, CPI is going to come out at 8:30 a.m. Eastern. If inflation comes in hot, rates likely tick up and housing sentiment wobbles in the short term. If inflation obviously is cool, mortgage rates are going to ease. People will see that as a green light for housing, a tailwind for housing activity. But here's the key thing. CPI moves sentiment, and open earnings are going to move the fundamental perceptions of the company. So don't confuse the two.